Hello everyone, welcome to the channel of Qianmo. In this video, we will talk about another area that often requires attention and adjustments when we are working on the year-end financial report for businesses, that is, hire purchase and chattel mortgage. When business acquires an expensive asset, like a vehicle or some heavy equipment, etc., sometimes they are paid by cash. However, many other times for cash flow or other reasons, they are acquired via various forms of financing. In this video, we will talk about two commonly adopted finances, hire purchase and chattel mortgage, and the accounting treatment for them. Hire purchase is an agreement whereby a borrower acquires an asset from the lender by making scheduled repayment to repay the balance of the price of the asset plus interest over a set period of time. Once the final payment is made, the borrower takes ownership of the asset. Chattel mortgage is also a type of finance that enables the borrower to acquire an asset by making scheduled repayments. This sounds similar, isn't it? Well, the difference between a hire purchase and a chattel mortgage is that in a hire purchase agreement, the borrower takes the ownership of the asset at the end of the term when the final payment is made. Before that, the lender is the owner of the asset, as the name suggests, hire and purchase. Whereas chattel mortgage is essentially a mortgage. The borrower immediately takes ownership of the asset, and the lender provides the funding needed to purchase the asset. Similar to a secured car loan or home loan, the asset that is purchased acts as security for the loan. However, from the perspective of recognizing the asset and liability, those two finance forms are identical. This is because even though the borrower doesn't own the asset from the beginning yet via hire purchase, this arrangement still provides for the obligation of acquiring the asset at the end of the installment period. As such, the asset will be eventually owned by the borrower, and a real liability is created when the agreement is entered. From the accounting perspective, there are three steps in recognizing those transactions. First, recognize the asset acquired and the finance liability raised. Second, record the installments paid each month in respect to the finance liability. Let's look at an example. Company ABC Pty Limited purchased a Toyota. The invoice is like this. The new vehicle price, $20,000. Dealer delivery charge, $1,000. GST in price, $2,100. Stamp duty, $500. Vehicle registration fee, $250. CTP insurance for the vehicle is $350. Assume that the company financed this purchase via chattel mortgage. Now, the first step is to account for the acquisition of the asset. So we debit the asset account, motor vehicle, $21,500. The GST paid account on the balance sheet, $2,100. The expense account for the motor vehicle registration, $250. And the expense account for the motor vehicle insurance, $330, assuming the insurance includes GST of $20. And we credit the liability account for this motor vehicle finance, which is in total of $24,200. Now, the second step is to account for the actual installment payments. As the motor vehicle is purchased via finance, the installments include both interest and principal. So here comes what we normally refer to as a hire purchase schedule, which is a schedule that lists the agreed timings and amounts of the payments. The calculation can be performed on an Excel schedule like this by inputting the information about the finance in terms of the principal, interest rate, installments, etc. However, for the accuracy of the information, we normally require the schedule from the lender. Now, let's have a look at the first month on this schedule. A repayment of $747 is processed from the borrower's bank account. From the schedule, we know that the principal is $606 and the interest component is $141. So we account for this repayment like this. We debit the interest expense account for $141 and we debit the liability for the motor vehicle finance, which is $606, and we credit the cash at bank for $747. This transaction will repeat every month. Ideally, the bookkeeping for those transactions are processed correctly and completely, but sometimes the asset may not be recorded in the account as there is no cash flow at the point of acquisition if the asset is 100% financed. If this is the case, when we are working on the year-end financial report, we need to identify those monthly installments, request the relevant information, and adjust for them correctly. Now, after we've done the above, the final step is to reflect the accurate presentation of this finance on the financial statements. Assume by the end of this financial year, 12 installments were paid. From this schedule, we understand that the remaining balance of the principal is $16,689. However, the total payments remaining over the next 2 years is $17,933, of which $1,244 is the interest amount. We present this interest amount to be paid on the balance sheet as well. How do we account for this? Well, we create an account beneath the liability for the motor vehicle finance and name it unexpired interest. Then, we debit this account the amount of the total interest of $1,244 that is expected to be paid by the next 2 years, and credit the liability for the motor vehicle finance account the same amount. In this way, the financial statements give clear information about this liability that the remaining principal of the loan is $16,689 and the interest charged will be $1,244. You must have noticed that the loan is for 2 years. So for the financial report to be more accurate, we split the presentation of this loan to the current liability and the non-current liability. The amount that requires to be paid in the next 12 months is current liability, whereas the remaining after 12 months is non-current liability. Therefore, instead of presenting in this way, we present in this way. Okay, the above is how we work on those two finances for asset purchases. You may find this complicated for now, but once you understand it and worked on it for a couple of times, you will find it not that hard. One more point to note though is that even though the accounting for the asset and liability is identical for chattel mortgage and hire purchase, there is still some difference in regard to GST, which is GST is charged and claimed on the interest component as well under a hire purchase agreement that is entered after 2012. But not under a chattel mortgage. So when we work on the year-end financial report, it is important to us to request for the related documentation for the details of the finance. Okay, that's all for today. Hope you find this video useful. See you next time.